I think most people probably know me, and maybe for the guests that are here, I'm the lead portfolio manager for Creek Capital Management, which means that I'm the guy who gets in trouble when things go wrong. But you know, I have a lot to talk about tonight with regards to our expectations for the market in the next 3 months to a year. And I'll certainly spend time going through that. I've also got some details on the portfolio as far as how we're positioned right now in our balanced model, all the different things that we own and why. And so I'll go through that as well. But I just wanted to sort of take some time to sort of pause and again, reflecting back on what Brett and Peter were saying, you know, really looking at what wealth is. And I think that, you know, certainly our role is always as investment managers. You know, you hire us to grow your portfolio as much as we can, and our job is to maximize return for the least amount of risk possible. And that's all well and good, but you know, as Brett was going through looking at people's titles, you know, we're more than investment managers. We're wealth advisors, and you know, I'm fortunate. I've been doing this for 15 years. Brett's going on 23. You know, Anissa's also been in this industry for a few decades as well. And with that comes a lot of experience in really working with hundreds of different families and seeing how people treat their money and how people use money as a tool. And it's quite a unique opportunity. I don't think there's anyone else that really gets the opportunity we do to be able to see how these hundreds of families that we've had the pleasure of working with, you know, utilize their assets. And the reality is you know, we bury a lot of clients with a lot of money, and so you know, I understand, of course, that you know, there's a sense of comfort and there's a desire to always want to, you know, have more. But you know, I think it's important to sort of pause and take into account this idea of, you know, why and what is enough. And you know, I hate to break it to everyone, of course, but you know, we're all going to die someday. And you know, the idea that of just sort of growing money for the sake of growing it. You know, I mean, our team, you know, we manage close to $600 million now, which is great. But, you know, for us, it's wonderful to be able to grow that pile. But of course, you know, the real passion and the real purpose, certainly in my role, is wanting to see that money be used by all of you to really find your purpose, and whether that is gifting to your children, whether it's gifting to charities, or whether it's just, you know, having a comfortable retirement so that you can enjoy and do things that are fulfilling for yourself. I think that it's we're very underutilized as far as our ability to help you really decide and define and work with you on these planning to really give you that confidence that, yeah, you're okay, and yeah, you can do these things, and sort of dig out and talk about what your dreams are and see if they're possible. And it's not just, okay, I'm going to retire and I'm gonna, you know, just gonna coast by and just sit on my money and watch it grow. Again, seen a lot of people stress about the market, seen a lot of people, you know, pay a lot of attention to the market only to pass away and have their children buy a place in Whistler. So just real quickly, I know that you skipped forward on this slide here already on Steve Jobs, but I found this on Reddit last week, and I thought it was great. These are some of the last words that Steve wrote in his journal. You know, Steve died at age 56. Obviously, you know, achieved the maximum amount of success this world has to offer. I'll just give you guys a minute. You've probably already read the quote, but just give a few seconds just to have a read through if you haven't. So for me, really, it's this idea that, you know, wealth is just a life experience I've had the opportunity to know. And I think that for you know, nearly all of our clients, you know, we're all in different ways had this opportunity to have wealth as a tool, and this idea that really wealth is a tool that creates opportunity. The more you have, the more options you have. But again, just want to sort of leave everyone with that thinking that, we'll always do our job to grow money the best we can. That's what you hire us for, but you pay us for more than that, and we certainly want to make sure that we're being utilized to help you really plan for your families and really find purpose with what you have to. So we'll skip ahead to the next slide, and I'll talk about the markets. So just an overview of sort of the market performance year to date, and this slide's not showing my highlights, but there's really, it's been a really crummy 21 months. Really, the market peaked at the end of 2021, and it's sort of been a pretty tough last 21 months. Certainly last year, 2022, was negative pretty much across the board. This year we've seen some rebounds. We've seen, sort of bits and starts, and then faded. And certainly even the last few weeks have been tough. But looking at the end of August, there's sort of two things that stand out. And I apologize, I don't think I can control the slides and highlight. But two things that I would show. One is the S&P 500 in the U.S. Has really led the market, and the S&P 500 has, as the end of August, was up almost 19%. This was after being down more than that last year. But really, this is a story of the major tech names. And so, there's 500 companies. The S&P 500 is the 500 largest companies in the U.S., and it's an index that measures the performance of those 500 companies. However, the big seven tech names, mainly Amazon, Apple, Facebook, NVIDIA, Tesla, and Google, I'm missing one more. There's a seven. Microsoft. Those seven companies make up 40% of the S&P 500, which means that the other 493 companies make up 60%. And so really, when looking at that index, it's the performance of those companies that has really driven it. And we were really fortunate this year. In hindsight, always, of course, would rather had more technology companies, but we had investments in many of those, and our U.S. portfolio performed and continues to outperform this year. The other thing to point out is the bond performance near the top, and this is over the market total returns chart. Bonds this year are up 1%. And, this is coming off last year and 2022 and 2021, where bonds were negative. And I was here last year talking about how the 2022 bond crash was the worst bond crash in history, in recorded history. And we're still, the bleeding has stopped, but bonds have yet to recover. And as I go through tonight and sort of talk about where the market is in the coming in the coming quarter up to the coming next few years, the major theme and how we see the markets right now is that bonds are going to outperform stocks. And this is probably the first time in my career that that's happened. But it's because interest rates are high, bonds are paying a ton, and they're really depressed in price. And the reason they're depressed in price is because rates have gone up so much, and the expectation is that rates will come down in the next few years. And so we not only will get paid the interest for owning bonds, but we'll see a significant growth in the price as well. And so as we're talking about the portfolio and how we're positioned, again, always looking for how do we maximize return with the least amount of risk possible. Bonds are clearly an area right now where we see that being maximized, that sort of risk adjusted return. You can switch to the next slide, please. So just sort of looking again quickly at the S&P 500. This is a 2-year chart of a few things. The red line is those seven tech companies I talked about. So again, we saw a massive crash in these companies last year over 2022, falling nearly 40%, and they recovered strongly to start the beginning of the year, and sort of caught up and led the S&P 500, which is the broader index. And so the story of this is that this is going back to the end of going back a few weeks ago, so it's not completely up to date for right now. But as we sit, the U.S. stock market is about 6% below where it was at the beginning of 2022. The Canadian market's about 10% below where it began 2022. So equities have been challenged, but we've seen a pretty strong recovery from where we were in December of 2022 and where we started the year. Next slide, please. And this recovery that we've seen is somewhat surprising because it's come at a time when interest rates are very high and continue to go higher. And typically, higher interest rates correlate with poor stock markets. And that's sort of intuitive because the higher interest rate costs are, generally the weaker the economy is, because people have less money to spend on dinners and vacations, and businesses have less money to invest and to hire because they're spending so much servicing their debt. So the fact that we've had this big market recovery this year, in spite of rates rising so much, is a bit of a shock. And next slide, please. And so the reason why we've sort of seen this is because GDP, so gross domestic product, or basically we could say the economy is very, very strong. U.S. GDP is forecasted to be nearly 6% for this quarter ending this month, which, looking back over the last sort of 15 years, is an extremely strong spike up. And so this has sort of created this hope, I guess, that we can achieve what's known as a soft landing, which is, we have inflation, we have to raise rates to sort of curb inflation, but how do we raise rates without crushing the economy, and how do we make everything run smoothly? And if you switch to the next slide, looking at the term soft landing, looking at Google searches, it's a very popular thing right now, on par with the Barbie movie, as far as people looking up this idea of what a soft landing is. And so, for our part, we certainly hope that we have a soft landing. We certainly hope that the stock market can continue to climb out of the hole that we're in, and that inflation will come down. But we also want to be realistic, and we want to position our portfolios to make sure that if that doesn't happen, we're doing the best we can for you. So looking at sort of where interest rates are now, this chart shows interest rate expectations going forward, but it also shows what those expectations have been, what they were 18 months ago in green, what they were 12 months ago, 9 months ago, 6 months ago, 3 months ago, and now. And so what's clear from this graph is two things. Number one is that people's expectations of where rates are going to be, and the market's expectation of interest rates has continuously shifted up and had to readjust over the past 18 months, which is why the bond market has been so challenged. But also, looking at the current dotted line at the top, the expectation is that rates will probably go a bit higher before they start coming down, and we see them drop over the next 2 years. So again, keeping in mind this idea that yes, interest rates are high, yes, they will probably go higher, but we do expect that they will come down over the next 2 years. The reason that rates are expected to go up still is because inflation, while it's come down a whole bunch, is still persistent. We're looking at this time last year, inflation around 8%, and now we're down to around 3%. So a significant improvement. However, inflation is measured year over year, meaning we're always looking September to last September, October to last October. And because inflation started to decline so much last fall, we're looking back at a lower prices. And because those prices are getting lower and lower as we move forward in history, stagnant, stable prices make inflation look like that's higher than it is. So what that means is that we don't expect inflation to be a persistent problem, but we do expect to see that inflation could creep back up to near 4% to start 2024, which is why we don't expect rates to start falling probably until at least the first quarter of next year. Another sort of challenge to the soft landing is this idea of all the money that was accumulated during COVID. So we had this massive accumulation as people were trapped at home and couldn't go out and spend, where we had this $2 trillion in excess savings. And measuring that going forward, or measuring that what's happened since sort of the end of the major lockdowns in 2020, mid 2021, that all that money has now been spent. So all that stimulus that came into the economy that really pushed GDP up, and which really fueled the economy and fueled travel and fueled many industries this past 2 years, that powder is essentially dried up, and that again creates some challenges for the stock market, and again is why we're somewhat concerned about equity prices going forward. Next slide, please. Another challenge is that, or another sort of sign of economic weakness is that delinquency rates are up on mortgages, on credit cards, on auto loans. Student loans are the only area where delinquencies haven't increased, but that's because there was a relief program brought in by the Biden administration to relieve student loans, which will be expiring soon, and so we'd expect to see those come up too. So again, this fact that there's less fuel, there's less excess savings, is starting to show up in some of these numbers. Next slide, please. Looking at unemployment or employment, still very, very strong. This time last year, there was 2 jobs available per unemployed person. There's still 1.5 jobs. This is still at record highs as far as employment opportunities go, but it has come down, and we're seeing employment opportunities start to slow a bit as well. Next slide, please. Another sort of major stall out has been expectations from China. So China was slow to come back from the COVID lockdowns, and when we started off 2023, China was opening its doors, and the expectations was we have this big sort of global GDP growth fuel coming from China. And looking at Chinese credit, or the amount of credit being issued in China as a barometer for how strong the Chinese economy is, we can see that it's faltered in the last few months. And typically, what the blue line is showing is how stocks have done versus bonds, depending on the strength of the Chinese economy as measured by credit. And so the fact that we've seen this sort of decline in credit and the Chinese economy suggests again that stocks have probably done a bit better than they should have versus bonds, and we would again expect to see bonds outperform in the coming quarters. Next slide, please. We still expect there'll be a recession. That's another sort of headwind that's ahead of us in probably the coming 6 to 12 months. What the chart on the left shows, these spikes up, is a measure of an inverted yield curve. And an inverted yield curve, simply speaking, is when short-term interest rates are higher than long-term interest rates. So right now, for instance, if you go to the bank and you want to invest in a GIC, or you want to buy a short-term bond, you will get paid more for a 1 year than you will for a 5-year. And that's sort of counterintuitive. It's typically the longer you would lock in your money, the higher rate you would get. But because the market expects rates to fall, the yield curve is inverted, and you actually get lower rates for going out longer. And so typically when the market expects lower rates are coming because there's expected to be economic weakness, there's expected to be the need to lower rates. And so this metric tends to predict recessions. It's the most accurate predictor we've had. And so the red dotted line going across that chart shows that every time the yield curve, that more than 60% of the yield curve has been inverted, going back to the 1960s, the gray bar is a recession. And so every time the yield curve has crossed and inverted more than 60%, a recession has followed. And so this is why recessions have really been the talk for the past year. For our part, we crossed that red line in November 2022, so just about a year ago. And in the top right corner, looking at these past recessions going back to 1969, the column on the far right shows how long after we crossed that line did a recession follow. And typically it was between 7 and 18 months. So again, we crossed that line in November 2022. We're at about 10 months out right now. So, the expectation is that we will see a recession come. Now, that doesn't necessarily mean that we're going to have a repeat of 2008. We certainly would never expect that. That was a banking crisis. And, we could have a mild recession. In fact, I've talked a lot in the videos I've sent out in my monthly updates about how typically the stock market actually does better during recessions than it does in the period leading up to a recession. So it isn't a reason for alarm, but again, it's a reason to expect that that investing in equities could be a bit of a challenge. Next slide, please. Again, this is just a chart showing the valuation of stocks versus bonds. That's at a sort of a 25-year high as far as the price of stocks to bonds. Next slide, please. And then this is sort of a chart showing the equity risk premium. And the best way to explain what that is, when I met with you guys 2 years ago and we had the option of buying safe investments, bonds, GICs. The interest rate you would get on those was like 2 to 3%, versus the stock market. The long-term return is about 9%. And so, you want 2 or 3 in safe money, or do you want a long-term expected return of 9 in stocks? And so there's about a 6% premium that you were paid for taking the risk of owning stocks. And of course, now with bonds and safer investments offering close to 6% and equity market returns, even if they are 9 and they could be lower than that over the next few years, that premium for owning equities has certainly been reduced. So next slide, please. And then just sort of last on the charts, and I'll hurry up here so I don't take you guys all night. One of the things that we look at all the time, and what National Bank puts out, is this investor sentiment index, which basically looks at optimism or euphoria and fear in the market. And it's a contrarian signal, meaning that when people are the most optimistic about the market tends to be when things go badly, and when people are the most pessimistic about the markets when usually the time you should be buying. And this was certainly consistent during COVID. It was consistent during the European debt crisis, and vice versa. When times have been really optimistic, we tend to see the markets drag a bit. And so we did hit a period where the market crossed that threshold. We just got through a period of quite a bit of optimism coming off this run in tech names that we had. Thank you for next slide. So this is how we're positioned right now and how we see the investment world. Again, for us, it's not about always having to own stocks. It's about how do we get the most return we can for the least amount of risk possible. And this is how we sort of see it today. And that is, owning, being overweight in cash and fixed income, being underweight in equities. We have a bit of alternatives, specifically gold. We're overweight in. And then if you flip forward to the next slide, this is a current snapshot of our balanced model portfolio and the weightings that we have in the different sectors. And so, a couple things to point out when we look at the equity side at the top: Canadian, US, international, and emerging markets. We're at about 50%, and we could be as low as 30%. That's sort of the minimum that in a balanced account that we can have for equity. 50 is pretty low. We can have as high as 65. I think the last time we had close to 50 was pre-COVID, and that was a good call. It worked out well. We were able to manage through that downtrend and bounce back well. Now, I get the question, well, why do we own any equities? And the reality is because we don't know what could happen, right? I mean, the market shot up after COVID and no one expected that. Anything could certainly happen. But when it comes to the equities that we own, this is where active management and what we do day to day and really picking the investments is so important, because we want to make sure that the investments that we own are really maximizing or giving us the most safety possible when we have a market like this that looks vulnerable. We have a 6% weighting in gold. And we also own, in our Canadian equity portfolio, we have a 2% weighting in wheat and precious metals, which is a gold royalty trust. So, we have quite a bit in gold right now, and I'll talk a bit more about that and sort of why that is. And then in the bottom section, these are all of our fixed income holdings. And again, this is where we really think that where the market's going to show, where the biggest returns actually going to be in the next 3 years, and where we see the most opportunity. And I'll just get you to advance the slide and focus on those specifically, please. Oh, so go back one, sorry. So just a quick reminder. So again, I showed this chart earlier with the market expectations for interest rates over the next 2 years. So when we're looking at stocks and stocks are much more a function of optimism and human behavior, and yes, there's a fundamental part to the stock market, but it also is largely tied to optimism and people's hope for the abilities of a company to grow and what they're going to do. Bonds are just math. So interest rates go up, bonds go down. Interest rates go down, bonds go up. And so when I look at this chart and I see that, in sort of late 2025, so call it 2 years from now, we would expect to see rates 1.5% lower, you can draw a parallel across to when the last time rates were that low, and that would take us to about this time last year, sort of in, well, I guess it'd be summer 2022 when we had rates at around the 4% level. And so we can actually look and see, where were these bond investments then? And it gives us a pretty good predictor of what the upside is on those investments, because as rates come back down to those levels, we would expect the bonds to return back to those prices that they were at when rates were there. So flip forward, please. So this is just, again, a list of the different fixed income. I use the term bonds and fixed income interchangeably, but the different investments that we have right now, sorted by the largest weighting down to the smallest. The column in red is how much each of these categories are down from the end of 2021. And so again, a significant drawdown in all these investments. The yield column is currently what we're getting paid to hold these. So on average, we're getting about 5.6% from these investments, which is a pretty good return. And more importantly, on the right, this is what I was talking about when we forecasted. Okay, well, if rates do come down by 1% over the next 2 years, what will the price of these investments go up by? And so we see, on average, about a 14% increase that we would expect from this asset category. So again, 5.6% you're getting paid every year as a yield. And then this expectation that sometime in the next 2 years, we're going to see an additional 14%. That's how we get to this expectation that our bond portfolio could realistically, bond investors and safe investors could earn 10 to 12% in the next couple of years on this and this investments. And again, why we see it being so promising. I talked about gold earlier and the fact that we have 6% in gold. We've always had a bit in gold. We've got a bit more now, and that is because gold is portfolio insurance. As you can see, both during COVID and during 2008, gold really spiked up during those times of crisis, and it tends to be a bit of a low volatility fear trade. So when things are going badly in the world, if there's any sort of crisis, gold tends to do really well. Now, gold has been pretty stagnant. I think that's largely because cryptocurrencies have sort of taken the place of gold as a trade, where people are using those now as an alternative to sort of as an alternative from gold. But really, gold is, again, both portfolio insurance, but it's also an inflation hedge. And so when I look at this chart and I see, gold is basically the same price as it was in mid-2020. And in fact, it's really pretty much the same price or a little bit above, but pretty close to the same price it was in 2011. That tells me, and over that period of time, from 2020 to today, cumulative inflation has been about 18%, yet gold hasn't moved. Going back to 2011, prices, the CPI, inflation over that period of time has increased by almost 40%. Again, gold still relatively flat. So, we see gold as having lagged. We see it having a fair amount of upside to catch up with inflation. And again, it provides us a safety during this time when things are a bit uncertain in the economy. Excellent, thanks. So just getting back to equities, and again, the idea of why we own equities and the equities we own. I'll take sort of the last 5 or 10 minutes just to sort of go through the portfolio real quick and talk about some of the names that we own and why. Just again to create that, so that you can understand how we're aligned and our thinking. I just wanted to sort of go through and talk about the specific investments and again set the landscape of how we're positioned, and despite the fact that we do see bonds as being this great investment, we do still see a lot of opportunities in the stocks that we own. And these stocks are what we typically look for, and what we're looking for now is safety, and that comes from companies that either have products that are recession-proof or sort of that consumer necessity, companies that have strong dividends and cash flow that are paying us a lot to own them, companies that are discounted already a whole bunch, that they've either fallen or they've been sort of underpriced. So we would expect that the future or the ability for them to fall further is somewhat muted. And again, these are all industries that we think that even in a tougher economy, we're going to see them do quite well. And so we've more than ever, these sort of 25 companies that we own across these different sectors really matter what those names are. And so we've organized them, or I've organized them in sort of the biggest to smallest positions, and I'll just go through them quickly. So the biggest area we own right now is really the defensive names, and these are companies that typically do very well during recessions. So in our portfolio right now, we have Estee Lauder, Diageo, L'Oreal, Nestle. So basically cosmetics, booze, and chocolate. And these are the same companies. When we look at their annual reports from 2008, 2009, which was sort of the last major recession. We had a recession during COVID, but it was so short, it's hard to really even account for that. But the last major recession, 2008, 2009, these are companies that their profits actually went up during that period. And that's because even when people don't have a lot of money, they drink, they eat chocolate, and half the population goes out and buys cosmetics. Maybe more than half nowadays, who knows? But these are companies that are extremely stable. They pay pretty good dividends, as you can see by the yield, and they're already, the drawdown column is showing sort of where they are from their peak or their annual high. Estee Lauder's sort of one that we've added recently. Again, that it's had some issues with its business in China, but we see that being a temporary thing, and see the future being quite bright for that company. And again, we see the ability for these companies to withstand the economy being quite strong. Second biggest weighting is technology. Again, technology has been a great thing to own this year. We were very overweight. It was definitely our largest sector weighting to start the year, which again, I said paid off very, very well. When you compare how much technology we own to the technology companies and the weighting of a typical mutual fund or a typical sort of off-the-shelf portfolio, we are very underweight technology. Technology should be the largest for everybody, and it pretty much is for almost every manager. It's our second largest, and we've chosen and we have actively been trimming it and adding to bonds and cutting it back as it's been succeeding this year, because of the fact that it is quite volatile and it can be quite sensitive to risk. And so not a lot of yield in the technology sector, but there's already been a fair amount of drawdown that's happened in these companies. So there's already some a bit of a discount. We're not buying them at highs. Companies like Microsoft, I think, is probably my favorite right now because of the investment. They own 49% of ChatGPT, so they're sort of at the forefront of the artificial intelligence trade, which I think is very exciting and could really have big benefits to that company over the coming years. So again, we see these companies being steady. We see the demand for technology continuing to be steady, but again, try to trim down and keep it focused on these core names that we love. The next would be consumer companies. So again, these are, unlike defensive consumer stocks, these ones are a bit more volatile because they rely a bit on the economy, on people spending. Yields are okay, but the companies themselves are of course very stable, household names, and overall, when we look at the drawdowns, especially on companies like Nike and Disney, already a lot of potential negativity priced in. So owning them here, I think, is a big positive. And companies like Visa and Costco and Home Depot, well, they could see a drop in price if there was a correction in the market. It's the kind of company where it's not something we're really going to worry too much about, because we know the businesses themselves are gonna push right through and recover, and we'd see that as an opportunity to buy more. Canadian banks. Next biggest sector, we own Scotiabank, National Bank, Royal Bank. Good dividends right now, especially from Scotia, and they're all down about 14-16%. So again, we see it as a great opportunity. I mean, every time going back to the 80s, the banks have been down. You should have bought them. So we're still actively adding to them. They're a key piece of the portfolio. We like the yield, and we expect that they'll outperform the market in the coming quarters. Utilities and transport. So again, these are companies that have stable cash flow, predictable revenues. Companies like CN Rail, of course, are a bit more tied to the general economy. But overall, good dividend yields from these companies. Fairly predictable, fairly low volatility. So when we have the market volatility pick up, these companies tend to outperform. And as seen by the drawdowns, these are companies that haven't really done much in the last year and a half. They're still quite a bit down from where they were a year and a half ago. Energy is always sort of a difficult area. People have different opinions about it. Energy and oil, as a trade, we expect to really outperform in the coming year, and that's for a couple of reasons. One, oil is around $90 a barrel. That's really high. The stocks haven't really reflected that yet. So all these companies are going to be cashing in big time on that price, and they haven't really, the stock market hasn't really picked up on that yet. And not only that, but we expect oil prices to spike up even more, because we see things like the U.S. strategic reserves. The U.S. holds a bunch of oil in storage so that they can sort of manage the supply and demand. Of course, with gas prices shooting up last year, the U.S. strategic reserves were almost drained out. They're going to have to refill those, so that's going to create a big demand for oil, and we expect the prices to go up. And at the same time, when you look at the current inventories of oil, we've got about 45 days globally of supply on hand, and that's historically really low. So we expect that despite people's opinions on energy and whether we should, get rid of it all and go to electric, what have you, certainly in the next few months as an investor, it looks really attractive and it looks like a relatively safe place where, again, we can see outperformance in the market. And these companies are all sort of, very, very low cost, stable properties, not a lot of development, very predictable cash flows. So we see good opportunity there. And next slide, please. Materials. So, I talked about Wheaton Precious Metals, which is a gold royalty trust. We've got a good chunk in that, and then our investment in copper in Capstone. That's a Canadian company with very low risk mines, and when it comes to copper mining, a lot of times there's a lot of jurisdictional risk because of where the mines are located. Capstone has got properties that are all very accessible in very stable locations, and copper in general. It does tend to flow with the economy, but with all the electrification that's been happening, demand for copper is just hitting all-time highs and continuing to grow. And at the same time, building copper mines is extremely expensive. There's a lot of regulatory procedures. They're very slow to get built, and so we do expect, just like in energy, that copper demand will outpace supply, and we'll see copper prices increase. And Capstone is a great company to take advantage of that in the next few years. Lastly, with healthcare, we have one investment, which is an ETF, an exchange traded fund that owns basically the largest healthcare companies globally. Now, this is a covered call writing fund, which means that essentially the company actively sells off the upside, so to create yield. So it's generating almost 9% in dividends, which is phenomenal. It's not expected to really increase in price a whole bunch because there's been so much that's coming through in the yield. But you can see the drawdown's actually been pretty low. Healthcare is an area we expect with aging demographics, with just the move towards healthcare after the last pandemic. It's an area we see growth. So just in summary, real quick, this idea that we do believe that the opportunities for us, the opportunities as active managers, really do exist in really positioning our portfolios to maximize return for risk, and see fixed income as a great place to really find those returns. And while we don't know for sure what's going to happen in the equity markets, we do expect there to be these challenges to the economy. And so we've built this portfolio for you that really addresses those, we think, and really positions us well for the year ahead. So I'll leave it at that and take questions.